This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today is episode number 50. Today's episode is titled, What are the basic systems that I need in my startup business? So friends, whenever we're dealing with systems, this can seem to be overwhelming. And I've boiled down the systems to 3 basics that we need. And we're going to spend some time today. This may be a little longer than normal episode, but I'm going to talk in depth about these 3 systems that every business needs. Big businesses have them, small businesses have them, or they need them. So let's jump right in. The first one is an accounting system. Now, one of the most difficult things for a business owner to understand is an accounting system. They are frustrating. I know business owners who to this day do not know how their company performed last month. They run successful businesses, and when I ask them, hey, let me see your current P&L, they're like, yeah, it hasn't been updated for like 4 months. I'm like, what? You mean you haven't updated your P&L for 4 months? How do you know how much money you spent last month? Well, I have a general idea. Like, well, how do you know what course corrections you need to make during the month? Well, I have an idea. And these business owners, the ones who really don't know how their business is operating on a month-to-month basis, these are often the most frustrated business owners I know. They're not able to plan for their tax planning. They're not able to make course corrections instantly when they see numbers going awry. I can remember a time whenever we were down in South Georgia, my brother and I were driving one of our trucks. I can't remember if it was his truck or my truck, but we were back on a dirt road somewhere and we had mud all over the window, and it was a hot summer day. We didn't have much water in the windshield wiper reservoir, and we turned the wipers on, and of course we had mud smeared all over the front of the truck, and it was Georgia gumbo is what we call it down there. And this stuff is slimy. I'm talking about like snot slimy. We literally could barely see out of the front window. We got off, took off our shirts, stuck them down in the mud puddle, and did the best we could to clear the window off, and we had to drive back to the house down long country roads with mud on the windows. Well, as you can imagine, that is frustrating to try to drive on a hot summer day whenever you want to run the air conditioner with mud on the windows and you can't run the air conditioner because you have your head hanging out. Almost like Ace Ventura style, right? Head hanging out the windows. Remember, he parked the car, he's like a glove. That's what it feels like to business owners who can't see clearly how their company is operating on a financial statement. Now, I have seen business owners who literally work out of a shoebox, literally out of a shoebox. They take their receipts from their purchases, they take their invoices, and they shove them down in a shoebox. And then when it comes tax time, they literally give the shoebox to their accountant and say, how much taxes do I owe? Guys, that's not a way to operate a business, especially as we're starting up. That's a bad habit to get into. Now, in the early days, when we're starting up a business, and I've been here, I've been exactly here. You're like, Justin, that's not me. I don't have enough money to deal with. Yeah, we're like counting pennies. We're watching every dollar come into our business and out of the business. The way I described it to a business owner the other day, I said, it's kind of like that bald eagle that sits in my yard. We live on the river and we have some beautiful bald eagles, and these things are huge, massive birds. And they're all the time like counting my chickens. My wife has like 60 chickens or so, and this eagle is up in the tree watching our chickens. He knows where chicken is, and the minute one gets away from the flock, he swoops down and has him a nice chicken for lunch or breakfast, because everybody likes chicken, right? That's how we are in our early days. We know where every penny is, and we know whenever we're running short or running lean or whenever we have an influx of money. I've been there. I've started many businesses. I know what it's like. But friends, in the early days, whenever we're counting our chickens or counting our pennies, that's whenever we need to develop and deploy systems which can be automated that'll help us as our business is growing. Not as it grows, but as it's growing and continues to grow. So what are these systems that I'm talking about? Well, there's 2 primary ones. The first one is what's called a balance sheet. The second one's called an operating statement. Your system will generate these 2 documents for you. So let's dig into what these documents are and what they mean for us and how do we use them. Well, The first one is the balance sheet. The balance sheet reflects everything the company owns, all the assets and everything the company owes. We call that liabilities. And oftentimes, the balance sheet will list things like our assets first. It'll list our cash, our real estate, our accounts receivable, our inventory. And then it'll list things that we owe, like the taxes we have to pay, the notes payable, the refunds that are listed to clients, 401k deposits, whatever they may be. The balance sheet will list those. And whenever you review a real-time balance sheet, we can learn so much. We can learn things like, what's the net worth? What is your net worth of your company? Well, net worth is your assets, what you own versus what you owe, your liability. We can do things that are called like a debt ratio test. Now, this test will show us if we're taking on too much debt in relationship to the assets we own. This calculation is made by looking at the amount of money you borrowed in relation to the assets which can be used to pay them off very fast. Yeah, like we borrowed money to build a website. You can't sell a website to pay off the car. You can't do that. So it's looking at things which you can turn to cash really fast, the debt ratio, look at things you can turn really fast in order to pay off a liability. Let's say like a car. So that's one thing we can look at with a balance sheet. Another thing you can look at is what's called the asset test. And this is referred to very loosely as the quick ratio test. Basically, the test is looking at the cash or the cash equivalents in comparison to your upcoming bills, your liability. And every banker looks at this. They're looking at the financial health of your company. And think about it. You have a small business and now you want to go borrow money to expand and you don't have a balance sheet and you're literally running the business out of a shoebox or you're running it off of receipts. How is the banker going to do his asset test? How is he going to look at it and say, you know, this company has enough cash or cash receivables coming in to pay off the liabilities or at least float the liabilities? So the asset test, and the banker uses that. The balance sheet will also reflect the average collection period. Now, this is big for manufacturing companies. This is big for service industries that have to manufacture product. For example, we use this test in our landscape business. Whenever I used to install landscapes, I knew this information. So what is the collection period test? It tracks how long it would take to turn accounts receivable, we would call that AR, accounts receivable into cash. So let's say you have $50,000 in accounts receivable and your average daily sales is $1,500. So if you have $50,000 in accounts receivable and you collect on average $1,500, that means it takes basically 30 days to convert your accounts receivable to cash. And when times are good, like the economy is right now, that time period may shorten. But when times are tough and people are holding on to their cash a little bit longer, if we have $50,000 in accounts receivable and we're used to collecting $1,500 a day, it may lengthen out. Instead of being 30 days, it may take 60 days. So the average collection period test is very good to know on futuristic cash flow. Now, each of these assessments are not magical in and of themselves, but rather they're like an x-ray. Like when you go to the dentist and he takes an x-ray of your teeth, these type of tests can be seen by a qualified advisor to know the health of your business. And the balance sheet is what gives us this. Now, the other report, which a good accounting system can generate, is what's called the operating statements. Now, these are loosely referred to, and I refer to them as a P&L, or profit and loss is what P&L stands for. And basically, this document reflects the income and the expenses of your business. If you have more expenses than income, you have a loss. And if you have more income than expenses, then you have a profit, which is what we're after. See, as a planner, I like looking at the balance sheet. It helps me understand the immediate health. It lets me know where you've been. But the operating statement for me is like a roadmap. I can read this as where you're going. It's one of my favorite documents. There are so many trends that a planner can read off of your profit and loss. So think about it. Before I even tell you these trends, think about a planner's perspective. I'm meeting with a client. I'm trying to show them how to grow their business. And I say, can I see your profit and loss? And they're like, yeah, we don't have one. That's like a dentist trying to tell you how your teeth are without ever taking an x-ray of your mouth. I mean, that just is not good business. I have certain clients whose businesses yield lower income in certain months every year. My brother, for example, and I just was on the phone with my brother, and he doesn't mind me using him as an example. In fact, he was laughing at it. He owns a pool business down in South Georgia. And the summer times, he laughed because it's hard for me to get him on the phone. He's like, dude, if you want to see me, come down here. It's pool season. Pool season for him is crazy. He is working 24 hours a day, it seems like. Whereas in the wintertime, he gets a little time off. In my business, Heritage Investors, tax season for us, oh man, I go brain dead. But in the summertime, it's kind of lazy for me. I have a little bit of time to deal with some things. That's when I do my CE. I know businesses that during the summertime, they're booming. During the wintertime, they're not. Spring and summer. So it just depends on the type of business you're in. And the operating statement allows a planner to look at that style. We can make comparison. For example, I'm working with a group of dentists right now. We probably work with about 60 to 70 dentists. And one of the things I hear from a frustrating standpoint of a dentist is, Justin, there's usually 3 or 4 months out of the year that my income suffers. How can we levelize the income? Well, the profit and loss tells me the details around that. So the profit and loss provides me a quick analysis of a company. I can check the company's expenses from certain areas and make sure they're not creeping up. I can look at a number of things. Now, maybe you do have your finger on the pulse, if you will, of your business just by looking at your purchase orders. Maybe that's you. I had a client that did that. He worked for years, built a multi-million-dollar business. But there are a few times whenever we are growing a business that just looking at the purchase orders are going to give us optimal or peak performance of our businesses. And that's what we're after. We're after highly efficient businesses. So, for example, how profitable is the business? This is something that I look at. These are some tests I look at from the P&L. How profitable is the business? So there's a calculation I can run called the net profit margin ratio. And it shows me how much money I'm making in my business. And it's a simple calculation. You can compare the net profits. Typically on a P&L, it's the very bottom number, shows net profits, to the sales income. So let's say that you sell $1,000 in a month, and at the end of after all your expenses, you had $100 of this net income. That means you have a 10% profit margin. That's not a bad number for some businesses. Now, other businesses, that'd be horrid. Well, over time, as your business grows and as you begin increasing your top line revenue and as you begin increasing your expenses, we want to look at and say, is there a way that we can increase our net profit margin ratio? And a P&L allows a planner and a consultant to be able to help you in that area. Another test that I want to do is I want to know how my business is returning for me as an investment. See, as a business owner, my business is often the largest investment I have. In fact, for me, it is my largest single investment. Now, I'm working to correct that, as you should too. It's dangerous to have all your eggs in one basket. We use that saying, but literally my son just 2 days ago, he had all the eggs in one basket, as a 6-year-old does, and he came running in and he dropped the egg basket and all the eggs shattered. So what we've learned from that is whenever our 6-year-old goes out to collect the eggs, we give him 2 baskets. Hopefully he won't drop them both. But that's where the saying came from. In our businesses is often our largest asset. So if I know that I can take my money and go down to the bank and get 1 or 2, whatever the interest rate is on the CDs, I know that number. But I want my business to make more than the 1 or 2% or whatever the number is at the bank. I want it to make more than that. But knowing what the return of our investment is in our business can be a little bit more complicated. It's actually called the return of investment ratio. And this ratio compares the net profits of your company to your company's net worth. So if I'm earning $100,000 in my company and my company's net worth is $1 million, then my return on investment is 10%. Again, so that's where a balance sheet or an appraisal and my profit and loss statement come to play to show that, hey, me owning my business, I'm getting a 10% return on my investment. Whew, that's a lot of complicated type of calculation, but it works. Many companies I consult, they have inventory. For example, my brother, like I was just mentioning, he's a successful pool contractor. And he's an example of inventory control. Many times when I go down there, and he and I were just talking about his inventory, he'll have pipes and pumps and salts and rebar and concrete and you name it. He's got all sorts of things to make a swimming pool. And one thing I've taught him to make sure is to make sure his inventory is not getting too large. And that's a subjective term, but we want to make sure his inventory is not getting too large. So what we do is we use the inventory to sales ratio. And this is an easy ratio. You basically are going to compare the value of your inventory or the balance of your sales for the month, and in some cases, a quarter. So we're going to compare the value of our inventory to the balance of our sales. So if the value of your inventory, for example, is $100,000 and your sales are $50,000, then you have a 2-to-1 ratio. And a 2-to-1 ratio may be high or low for your particular industry. But here's where it gets interesting. If you're dealing with inventory and you've historically had a 1-to-1 ratio on this inventory to sales ratio test, and all of a sudden we see a 2-to-1 ratio as we're running this exam, then obviously there's something going on. And it's an indicator. It's an indicator for us to look deeper into the business and find out what's going on. So that's just another type of tell that a good operating statement can provide. So one of the very first important systems we have to have is financial systems. And you're like, Justin, holy cow, that's a lot of information. Here's the good news. I've already told you that we need to hire a good CPA, certified public accountant. And an accountant can help you use systems. Things like QuickBooks is the company I use. I recommend them. I like them. They work good for small businesses. Some CPAs don't use them. They use companies like Peachtree, and there's a number of other ones. But a good CPA can help you develop your systems, and they can maintain them. What I tell my business clients is by the 15th of every month, so let's say we're in April 15th, I should have my March numbers completed by my bookkeeper, and they deliver those to me so I can review them from a planning perspective and make sure I'm on track. That's where the systems come into play. Now, let's think long term. This particular financial system is also going to come into play at some point when you want to sell your business. A buyer's going to look at these systems and make sure that you've been operating your business above board all these years.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
Another system that we use is what's called KPI. KPI, and that stands for Key Performance Indicators. And they're not financial in nature, but they're just as vital to the successful operating of your company or your business. See, your goal as a business owner should be to identify the exact indicators which provide you a forecast as to the success of your business. And the difficult part of KPIs is they're different for every business. My business as a financial planner is totally different than my brother's business as a contractor, which is totally different than the client I just spoke with who's a dentist. We all have different indicators. So, for example, the dentist may look at the calendar, at his calendar or her calendar, and the patient schedule as the indicator for potential income in a given month. They can look at the calendar, see who they've got scheduled, what treatment plans they have scheduled, and they can know, based on that information, how much revenue they are projected to bring into their company. In the financial world, a financial person like myself may look at a calculation of assets under management or recurring revenues. How many fees do I have coming in? And I can make assessments off of that going forward to make sure that my team is cared for. You know, a contractor may look at the number of projects under contract. Each of these KPIs are different, but one thing they can do is they can forecast the income. However, KPIs are not just for forecasting income. That's one of the things they can do. But we must also develop KPIs, key performance indicators, to provide us a detailed analysis of things like our potential income, of course, but also our potential expenses, the potential growth pains we have, the risk, the rewards, whenever we need to hire somebody. The goal is to build a detailed system so that you, the owner of your company, can see clearly the strengths and weaknesses of your business. So, for example, in my company, Heritage Investors, we had, because of you, our listeners, and because of our readers on our podcasts and some of the national writings I do, and just the notoriety that we've had, we have a lot of people who call us and say, hey, Justin, we'd like to work with you. And friends, there's no way I can work with everybody. So what I'm trying to do is I'm like, I can work with probably another 100 clients myself with my team before I have to now start having new people work with our team. That's one of the frustrating things, by the way. Here's a rant case for me. And this is 20 minutes into this thing. I'm going to tell you a rant. A rant is whenever I hear these people, these big talking heads say, hey, come work with me, and knowing good and well that I'm not going to work specifically with those talking heads. Just not. Now, those talking heads can influence things. But right now, the cool thing is I have room to work with a few more clients. And business owners, I love them. Nonetheless, in my company, I saw recently that we had a number of people calling us. Some are qualified to work with us, some are not. But I realized that I'm going to have help based on some key KPIs that I have in my business. And so we went ahead and hired somebody. We just introduced a new employee to the firm. She's an awesome team member. She's already in the first 2 weeks has shown some really cool information to us. So we're excited about that. So the question is, how do I find these KPIs, these key performance indicators? So here's the way I deal with that. Number one, we have to determine what information I need to see if I were going to try to buy my business. Now that sounds a little weird, but let's unpack this information this way. Let's say you're a business owner and you want to make an investment and buy your business from yourself. What information would you like to see? Well, I'd like to see the revenues. I'd like to see how many prospective clients or how many prospective widgets you've sold. I'd like to see the number of sales increase, the number of sales decrease. And the information goes on and on depending on the type of business you're in. The idea is if you're looking at it from a buyer's perspective, then you can often identify the information which is most vital to ourselves. See, as we're operating our business, many times as we're operating our businesses, we don't realize how much valuable information we have in our head. And when you look at the business from somebody trying to buy your business and you realize, you know what, if I were hit by a train tomorrow, could my business sustain itself? I need to get that information out and create an indicator off of that information. So if someone were to buy my business, then they could realize the information I have in my head. So that's one of the questions I often ask people is, what information would you need to see if you're going to buy the business from yourself? So once you identify as much data as possible to answer that question, the next thing we're going to do is we're going to create a system to produce, compile, arrange, and present this information. You're like, what? So yes, we're going to create a system. So let's say, for example, let's use a simple example here. Let's say that I want to buy my business for myself. Well, I want to buy Heritage Investors for myself. Well, one of the things I would like to know is what is the 5-year historical trend of your business? How much have I seen the net revenues of the company grow year over year for the last 5 years? So let's make an assumption that it's been 10%. Let's just use that as a round number. Year after year for the last 5 years. What I need to do now is compile that information to be able to prove that I've had a 10% growth. I need to arrange it in such a way that I can present that information to a prospective buyer. Now, I know we're not selling the business. I realize that. But KPIs are designed to look from the outside in so that we can analyze our business to realize how effective they are or how we can take the information and improve our businesses. So that's the idea behind taking their question, compiling it, arranging it, and presenting it to ourselves. Once we present it to ourselves, then we're going to analyze the information we receive from a potential buyer's perspective. So we're going to look at this information and say, okay, if I've done it 10% year after year after year, what have my peers done? Oh man, other financial people have done 30% year after year after year. Why am I 20% below my value? Well, then we could dig in and understand why that is. And then what systems can we create that will alert us to those slight variations? So that's my style of business. My brother's business, he can track, and we do track this. We track how many contracts he has signed for pools, how long it takes for a pool to be built, how many employees lay out or lay on the job. There's a lot of different key KPIs that we track to determine the future revenue, the future expenses, the future projection, the future trajectory, all those things in the future of our business. And that's what a KPI is. And if that's not enough, the workflow, number 3, comes into play. The workflow is different than a KPI. Basically, these are the steps that we're going to take to move our product or service to market. And at this point, if you really think about that question, you probably realize that there are dozens of steps. Yes, welcome to workflows. So here's an example, and we're going to overly simplify this, and then I'll make it extremely complicated so you can see why this information is vital and how arduous of a time this can be, how hard of a time it can be to build right workflows. Friends, in my company, we are working daily on improving or increasing our workflows. And I'll tell you why in just a second. But let me give you an idea of a workflow so you can understand what we're talking about first. Let's say that you're in a widget producing business, and I don't care what the widget is. Let's say it's coffee cups. Whatever, it doesn't matter. But let's use that as an example. Let's say that you just received an inquiry from your website or from a friend, doesn't matter, that you have somebody wanting to buy 20,000 coffee cups from you and they need them delivered in the next 3 weeks. A workflow is going to lay out every step to move it from that order to delivery. So here's an example of a workflow. And these are just the high levels. So the first thing is we're going to receive the client order. Okay, what do we do when we receive the client order? There's a workflow. Well, we're going to put their name into the customer database, the CRM system. We're going to create a ticket order, a purchase order. There's all sorts of things there that once we receive the order. The next step is we're going to email or contact the client to confirm that this is actually a legitimate order. That may be automated. It may be manual, depending on your business. The next thing we're going to do is we're going to get some information. We may send them a questionnaire. We may have an intake form. What type of coffee cups do you want? Do you want them colorful? Today, if we're dealing with widgets, the website may do some of this. If you're dealing with a service company, you may have to manually do this. So after you send them the questionnaire, then you're going to get the questionnaire back. There's a workflow. What are you going to do with that questionnaire? We're going to make sure the questionnaire is legible. There's all different steps with just receiving the questionnaire back from the client. Then we're going to send a retainer invoice, perhaps. Maybe we're going to send them a 10% down. Maybe it's cash upon delivery. That's a workflow. Now we're going to go shop and gather the materials. We're going to go to our suppliers and make sure they have the exact coffee cup that we need to provide, these 20,000 coffee cups. There's a workflow. Once we get the coffee bucks back, now we're going to integrate in some marketing for our marketing campaign. We're going to take some pictures of the new inventory so we can market it out on social media so we can get more information or more prospective clients. There's a workflow to that. Who's going to take the pictures? Where's it going to be listed at? What's it going to say? Et cetera, et cetera, et cetera. Once we take the photos and we share it on the market campaign, we're going to let the client know the status of their order. Who's going to do it? How are we going to do that? That's a workflow. We're going to send them a balance invoice. Maybe it's not a COD. Maybe they have to pay us cash up front before we deliver the order. Whatever it is, we're going to send them that invoice. There's a workflow in and of itself. We're going to finalize the order and deliver the order. And we're going to write a thank you note saying thank you for ordering these 20,000 coffee cups. Who does that? What are the different steps in that particular area? And before we send them this, we're going to take more photos of the 20,000 coffee cups and we're going to share it out on Instagram. We're going to let the whole world know that so-and-so getting 20,000 coffee cups. And then we're going to send an email confirmation that, yes, you should have received this order. And then we're going to follow up with them after they receive the order to make sure they're happy with the order. And then after that, we're going to go back to them and ask them a customer satisfaction survey. Now, that is extremely simplified. In our office, we currently have in excess of 100 different workflows. So let's say someone wants to open up a IRA. That's a workflow. Let's say someone wants to open up a Roth IRA. That's a workflow. Let's say like today, we have this young entrepreneur doctor. His wife's a neurologist. He's a oral surgeon. They want to hire us to help him buy a practice. In that buying a practice, there's literally like 40 different workflows that we have to work through to make sure that every step along the process is not missed. And you're like, dude, Justin, why? Well, friends, I don't know about you, but I want to build a business that is capable of running without me at some point. My business, Heritage Investors, is really close to that. Now, I still have to do a little bit of work because I have a lot of clients I know, love, and trust, and to me, it's not work. I love what I do. But there are many businesses out there who could operate autonomously as owners who never go step foot in their business. If you can create workflows for how the job needs to work, then you have accountability measurements. And if you have accountability measurements, then you have a way to make sure the job is being done. But if the whole job is relying upon you, the grand poobah, the chief bottle washer, the CFO, the chief executive in charge, whatever title you're wearing, which most of us wear a lot of them, then we really don't have a business. We have an overpaid job with a lot of risk. So where workflows come in, number one, is it creates a job. It moves us from a job to a business, so the business can operate autonomously without us, number one. Number two, it also makes the business extremely valuable from a sales perspective. You see, if every area of my business can operate without me, then an investor will pay me more for a business that doesn't require their immediate or their intimate working in our business. That's number 2. Number 3, companies with workflows have less liability because they can produce holes, identify holes, so there's less liability there. That's number 3. A 4th thing that workflow does is it makes the company efficient. You're like, Justin, that is a lot of work. You're asking me to deal with financial systems, KPIs, key performance indicators, to know how my business is moving on a day-to-day basis, and you want us to work on workflows. Dude, when am I going to actually do my business? Yeah, welcome to a startup, which is why so much of our energy is used in the beginning. But friends, if you neglect any of these systems in the infancy of your business, it is going to take you more time and energy in the latter part of your business to get these systems off the ground. So how can you implement these systems? Well, the financial systems are easy. You can hire an accountant or a CPA. And I recommend that strongly. In fact, we made a rule in our company, Heritage Investors, that we're not working with any new clients who do not have CPAs. We're just not, because that's how much we value CPAs. So accountings are easy. KPIs, you're going to need a business coach to help you on that, many of us. I have a business coach for my practice. He helps me look at the KPIs. I work with almost 100 different small business owners on a coaching level, and we identify KPIs, and we work and constantly monitor these to make sure the businesses are savvy. Now, workflows, if you work on those slowly, there is no way that my company has the manpower to create 100 different workflows at once. No, it takes years upon years. I'll give you an example. Right now, today is, as I'm recording this, April 10th. This episode will probably be released in about 3 weeks toward the beginning of May. Hopefully by the time you go here, check this out. Heritage Investors currently, when you go there, are financially simple and you say, hey, I want to talk to Justin about hiring Justin to work with me in my business. Right now, I do not have a solid workflow that qualifies prospective clients. And so therefore, we've noticed that my time is getting wasted many times. That sounds harsh, but many times my time is getting wasted by individuals who really don't need my help or aren't qualified for my help. And so we're working on a workflow now, almost like a funnel in this case, to help people decide if they should hire me. So that's a workflow. I didn't have this 15 years ago. I've never run into this problem before. So I'm creating this workflow and I'm documenting it now. So as our business continues to grow, hopefully we can just slightly adjust the workflow from this point forward. So friends, I'm going to wrap it up with that. We're longer today than we normally are. Thanks for joining me on this journey of Financially Simple podcast. As always, I'm going to put lots of show notes and links in today's podcast, and you can find that at Financially Simple in the heading podcast. Hey, while you're there, feel free to sign up for our new weekly newsletter. I mention this every week. I do some of the best writing in our weekly newsletter. I'm dealing with business tips, wealth management tips, tax tips. I just had one of our clients read the newsletter. He's like, dude, this is really good. I'm like, yeah, man, thanks. In our next episode, we're going to be dealing with what are the basic insurances that have started business needs. And we have a special guest coming on. I can't wait for you to hear this one. Hey, look, if you like the show, please subscribe, share the podcast. If you don't like the show, share it anyways. As I say every week, life is hard. It is. I currently have family members who are really sick, and life just is hard sometimes. Life is good. My little girl just celebrated her 13th birthday yesterday. That's a sweet time. Life and business can be frustrating. These workflows, KPIs, I got gray hair at age 39 years old. Lots of it because of this. Money, it doesn't have to be frustrating. Let's continue to make our lives at least financially simple. Hey, y'all go out and create a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.